Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, how is Canada's biggest province grappling with an economic slowdown? And the Premier of Alberta on pipelines, trade, and Canadian spirit. Plus, a U-turn on electric vehicles might have governments rethinking subsidies for auto. That's all ahead. But first, for the week that was in business, it's time for the briefs. The minority government saw its budget pass in a narrow confidence vote this week as Green Party leader Elizabeth May supported the government and several other NDP and Conservative MPs abstained. May said her vote was in exchange for a commitment by the Prime Minister to meet the Paris Agreement climate targets. Price increases eased slightly in Canada last month, but not enough to take the Bank of Canada off the sidelines. Headline inflation was 2.2% in October, below September's rate, led by falling costs of gas and food. But inside the data, it looks worse. RBC economists calculated that almost half of consumer prices are rising at or above 3% in the past few months. The pace of new home building fell 17% in Canada in the month of October, according to housing agency CMHC. The declines were led by Ontario and BC, but starts in other areas, including Montreal, Calgary, and Edmonton, put the rate of new housing starts in positive territory this year compared to last. The Canadian government is reportedly imposing some net benefit requirements on Britain's Anglo-American for it to proceed with a takeover of Canada's tech resources. Anglo had already said it would locate its head office in Canada, but it seems the feds may want it to go further, including re-domiciling so the combined entity is a Canadian, not UK firm. If you bought into Bitcoin this year, you may now be losing money. The cryptocurrency has lost 30% of its value from its peak in October and has now given up all of the gains for the year. Competition from stablecoins could be driving uncertainty in the value of Bitcoin, which has no fundamental backstop. And those are your business briefs. New federal support should open investment flows to the province of Ontario, but will that be uneven? Daniel Tisch is president and CEO of the Ontario Chamber of Commerce. Thanks for being with us.
Hi, Amanda.
So post-budget, is there a sense that there is a change in the investment climate here? Was enough done, I guess, Daniel?
Well, on the whole, I think the budget goes in the right direction. That's what I've heard. You know, the business community likes the ambition. It likes the direction. There's some disagreement about whether it goes far enough or fast enough, but fundamentally, it delivered on a lot of priorities that we had identified as a chamber. We like the productivity super deduction, the enhanced research and development tax credits, the money for sovereign public AI infrastructure, and the new funding for venture and growth capital. So single biggest thing we have to do is help high potential businesses scale in order to assure the future of our economy and to ensure business has the right incentives to invest in productivity. So we like the signals, and the nice thing about going in the right direction is we can always track and evaluate how we're doing and push the government to do a little more and go a little faster. You know,
one of the emphasis, and Ontario is a big recipient of this for the major projects, is mines, for instance, critical mineral mines. And those can be big, labor-intensive, kind of big ticket items, Daniel, but they don't really help, somebody who's living in Aurora, Ontario, day to day. Is there enough in here? And I guess you're kind of alluding to it. Tax reform is one thing that wasn't really tackled in this budget. Is there more we could do to help businesses scale and grow and not just do those big kind of high profile targets?
Yeah, it is challenging because the reality is it took us many years to get into this productivity challenge we're in, and it'll take many years to get out, right? The solutions to that which ails Canada are very much long-term in nature. But I agree with you, and certainly that's very consistent with what we said after the budget. We'd love to see a more comprehensive top-to-bottom review of not just federal spending, but federal taxes. Provincial as well, I should say, further to the fall economic statement of the province. And you're looking at all the taxes, both taxes that are charged and tax incentives and measures that reduce taxes, which are most effective at actually incentivizing gains in productivity and which are not, right? So I think that we need to do that. I think we have to look at EI modernization, certainly for workers, making eligibility simpler and faster and fairer, especially if you're in a non-traditional or seasonal or part-time work mode, which a lot of people are. Yeah. And for employers, reducing volatility of premiums. The other thing I'll say is we'd love to see continued regulatory reform and faster deployment of digital infrastructure.
All right. And just finally, really quickly, you just kind of had a summit. Are Ontario businesses feeling confident about the future right now?
Well, business confidence has gone up and down this year like a yo-yo. We've been measuring it steadily throughout the year. We got another survey in the field right now. But what's interesting is while about a third of businesses say they're confident in the economy, 61% told us that they were confident in their own business prospects and their own resilience. So we're seeing resilience in the business community, which was encouraging.
So good to have you, Daniel. Appreciate your time.
Always great to chat, Amanda. Thank you.
Daniel Tisch, President and CEO of the Ontario Chamber of Commerce. Coming up, the Premier of Alberta on major projects, provincial cooperation, and the need for growth. Welcome back. The latest announcements from the Major Projects Office did not, again, include any major projects in Alberta. On the Wonk podcast this week, I spoke to Danielle Smith, Premier of Alberta, who remains confident that an agreement for a pipeline is at hand as part of a bigger agreement with Ottawa.
Yeah, because our negotiation with the federal government is more than just a single project. It's actually two projects because we've been linking the Pathways project to have a lower emissions barrel going through our future pipelines with the need for a new bitumen pipeline going to Asian markets. So those two things are together. But we also know that you have to have investor confidence back in order to have the expansion in the production that is going to fill that pipeline. Because the way pipelines are normally built is that a pipeline proponent would go out, they'd line up those who want to put their product on it, and then we'd be able to get private sector funding for it. Well, no one's going to expand their production if they face an emissions cap, which would force them to shut in. No one is going to expand if we have really aggressive and expensive carbon taxes that are being implemented by 2030. So these are the reasons why we have to look at the 9 bad laws that have impacted our investment climate, as well as those two projects.
Premier Smith is also convinced that changing the legal environment will be a key part of attracting new investment to the province.
Certainly. I mean, we know capital went the other way. I think we estimate there's some, $500 billion worth of projects that went elsewhere. They didn't evaporate. They just didn't come to Canada. And so that's why we think that if we get the investment climate right, those dollars will come back. We're already beginning to see some early signs of what that might look like. When Enbridge announced that they want to expand their main line, you've got Trans Mountain wanting to maximize and optimize their system. You've got South Bow with a pretty extensive project that builds on the old Keystone assets. That is a bit of a taste, I think, of things to come, as long as we've got our producers willing to expand their production, and that won't happen without addressing those bad laws. So I'm feeling like there is some early indication that the Prime Minister and his government is prepared to move in that direction, but we won't know for sure until it's in writing.
I asked the Premier if the spirit of cooperation is alive and well between the provinces as the months go by.
Well, I can tell you what my tone is. I support every single project that has been announced so far. I want my neighboring premiers to do well. I love the fact that we now have 2 major LNG projects that are on that list, LNG Canada 2, as well as Silisms. I mean, Silisms is going to be important for Alberta. I think about half of the gas going through that line is going to come from Alberta's gas fields. And so I think that we do benefit from seeing these projects go ahead. We benefit from getting mining going again. That's going to benefit every single province, and I think it's going to change the conversation. So I'm encouraged by what I see. I just I have a little bit more convincing to do, I think, of on certain projects and with certain premiers. But what I tend to do is focus on areas where we can agree. And Premier Eby and I agree on the expansion and optimization of the Trans Mountain pipeline. We agree as well on the dredging of the Second Narrows so that we can get more ships going through there with heavier weights. We agree on working together on interties. In fact, I think that there's a real opportunity there to leverage our solar and wind assets with the hydro assets to treat hydro almost like a battery backup. We also are going to, we've worked together on biodiesel. They have a much more stringent clean fuel standards, and a lot of that biodiesel is coming from canola that is grown in Alberta and processed at the Imperial refinery. And we are such a huge champion of Port of Prince Rupert, which I look at it as Alberta's port and the increasing investment going there. So I would say we can always focus on the things we disagree on. I tend to focus on the things we do agree on and hope that we'll just get more and more areas of agreement.
The current state of Canada's trade relationship with the U.S. remains top of mind for Premier Smith.
I'm disappointed that it seems to me that Canada probably should have been the first to develop a free trade agreement with the United States. And now it looks like we are the last priority. And that's very unfortunate. But where I'm encouraged is that it seems to me business is going ahead anyway. When I look at our own relationship with the United States and the fact that we have carve-outs for Canada, U.S., Mexico agreement compliant goods, that's 97% of the product from Alberta. I know it's a little bit lower in the rest of the country. There's about 15% of the product, I believe, in Ontario that is subject to tariffs. But what is happening now is that we're seeing that industry is developing their own deals. Cameco and the nuclear deal that was signed, that's one example of how we're going to leverage our uranium resources. But Westinghouse is very likely going to also produce the nuclear facilities in the U.S. We've got the Enbridge and South Bow projects that are also going to deliver more oil to the United States. So those are another example of industry just moving on. I think that our pathway to a solution is probably those kinds of agreements. There's a critical minerals agreement to be had for sure. There is very likely as well an agreement that could be had on aluminum. It never made sense to me why they would have tariffs on aluminum since they need it so badly and are unlikely to develop their own local supply. Steel is going to be a little bit more challenging because the Americans are worried about China dumping into our market and then us turning around and undercutting American suppliers. So that's going to take a little bit more work. The hardest one, of course, is going to be softwood, which has been a problem going back to 2015, and autos. It's quite clear the U.S. president wants to have finished vehicles in the United States and in Michigan in particular. And so I don't know enough about that industry to know the pathway forward to try to find a resolution. I think that'll be up to Premier Doug Ford to try to find that with his auto sector. But that is going to be a very, very tough negotiation. But it shouldn't stop us from trying to develop deals on all those other fronts and then hoping that the CUSMA agreement remains pretty much as it is. That's what I think that everybody's looking for. Let's just try to maintain what we've got and then deal with the individual sectoral problems one by one.
I asked Premier Smith about the recent ad run by Ontario Premier Doug Ford, which inflamed the U.S. president.
My preference would be for us to have a diplomatic approach and to try to find areas of common ground with the United States as opposed to antagonizing the decision makers. That's been my approach from the beginning. For better or for worse, I think it's allowed for us to maintain a very strong diplomatic relationship with the United States. I got a chance to see Interior Secretary Doug Burgum when I was at a recent conference in the Middle East. And we've got I think that the Americans are very keen to work with us on energy. That being said, I know that Premier Ford is in a very different position. It's why I signed a memorandum of understanding with him that we're committing to give priority to finished cars from Ontario in our fleets. And I hope that others will do the same. We've got an agreement to work on building pipelines. And I know that there's a potential for us to have oil loaded on ships in Thunder Bay and then potentially go out to the Atlantic and to our trading partners in Europe. There's another potential option to have a spur line going from up to James Bay, which would unlock, I think, not only the critical minerals that Doug has in the Ring of Fire, but also a potential for gas as well as oil. So I'm doing what I can to work with our counterparts to find ways to support their industry. In fact, stemming from a trade mission I did to Toronto and Montreal and Ottawa, we came up with the idea to try to have a three-way a chamber-hosted event where the three premiers would get together and say, hey, how do we bring the supply chain home? And what can we do to support each other? I think that's where I would like our next conversation to go. I know the American relationship is so important and it's going to overshadow everything we do, but why not trade more with each other and try to find ways to support each other? That's the approach I'm taking.
I also asked Premier Smith about the importance of creating a climate of growth in Canada.
Well, I think that Canadians need to understand that we're all broke. Every government, our government too. I mean, when we look at $60 oil, we need $74 oil to balance our budget, and it looks like it's going to be lower than that for some time. So even Alberta is facing a $6.5 billion deficit this year. Every province is in the same boat. The federal government is even worse. And the only way you solve that is that you either have to cut spending dramatically or you have to increase revenues dramatically. And the way you increase revenues is that you've got got to support true wealth creating and job creating projects. So that's what I'm seeing, is that I think that the world has begun to, or at least the Canadians have begun to understand that you can't keep printing money forever. All it does is lead to inflation and affordability problems. And from what I have seen of the major projects list and the provinces that are proposing them, it seems to me like every premier gets it, that they need to support the private sector in these kinds of investments so that we can do our job in being able to address the social services that people need. So that's why I'm feeling a little bit more optimistic. It's a very different tone than a year ago.
That was some of my conversation with Danielle Smith, the Premier of Alberta, on this week's episode of Wonk. Coming up, Canada went all in on EV manufacturing. Was that a mistake? That's still ahead. But first, here's a list you don't want to be on. The most stolen cars across Canada last year was the Toyota RAV4, more than 2,000 thefts to its credit. In Ontario, the crown for the most stolen went to the Honda CR-V at 1,300 thefts. But for per capita thefts, that is the likelihood that of all the cars of your brand on the road, yours will get stolen, the crown goes to the Lexus TX series, with about 15% of cars out there being nabbed. It's a reminder, sometimes being popular comes with a price. We're back after this. Welcome back. Canada has made some big bets on EV manufacturing in recent years. Here's a look by the numbers. To persuade Canadians to go zero emissions, the feds have spent more than $1 billion since 2016 on efforts to make EVs affordable and practical. That includes $218 million over 5 years back in 2019 to deploy 33,500 EV chargers across the country. It was followed by another $400 million in 2022, which extended the program to 2027. But direct investments in the production of EVs in Canada have also received billions. That includes $5 billion pledged for Honda's first EV plant in Alliston, a plant that was put on hold this spring because of a slowdown in EV adoption. Volkswagen was the recipient of $13 billion of government support for its EV battery plant in St. Thomas, Ontario. The plant's supposed to be up and running by 2027. Sweden's Northvolt, which has declared bankruptcy, had a planned $7 billion EV battery plant in Quebec that included almost $7 billion in government incentives. Stellantis' Nexstar energy plant was due to be online later this year, a $5 billion project that included $15 billion in tax breaks. It now faces legal action from the federal government over its plans to move that capacity south. GM's BrightDrop EV vans plant in Ingersoll was shuttered in the spring after Ottawa invested $518 million in the $2.3 billion plant. The announcements and the spending were supposed to be part of the future of Canadian auto manufacturing. So was that money well spent? Brian Kingston is the president and CEO of the Canadian Vehicle Manufacturers Association. Brian, thanks for being with us.
Thanks for having me on.
So some of that money was sort of promised and it won't be spent, especially tax incentives, but it was a real big push into the EV space, and we see increasingly that maybe the market's not ready for it. Was it a mistake, or does the government have to be there ready with incentives in order to even be in the game?
It was absolutely the right move because it led to Canada securing $46 billion in new automotive investment of a total $175 billion that was deployed across North America since 2020. Canada received 14% of that share, which is almost double our historical share of new automotive investment. Now, we've absolutely seen a slowdown in the EV market and it's frankly a collapse of EV sales at the moment, but that doesn't change the direction that the industry is going. We are electrifying. These investments will pay off, but it's going to take more time. There's
some big questions, of course, because of the behavior of the U.S. government about where future investments will be made. It's a lot of the big automakers are looking to the U.S. because it's practical to do so, Brian. Do we still need to lure them here, or are we now kind of sending good money after bad if they're going to end up making a decision to be located in the U.S. anyway?
Well, priority number one has to be getting an agreement with the Americans to eliminate the Section 232 tariffs and to renew our North American trade agreement. Of our production of auto in Canada last year, 92% went to the United States. We are totally integrated. We always have been. We have to secure a deal with the Americans. Very difficult to have an automotive industry in Canada without access to that market. So that's got to be goal number one, and I'm confident we'll get there. The Americans need the Canadian market. We are their biggest export destination by far. So there is a deal to be had, but we got to get back to the negotiation table.
There's also some debate, of course, and there might be a change in Canada's planned sort of path to EV adoption. The government's kind of idealized plan for that is under review. What are manufacturers to make of that when the rules have kind of changed? I don't think we've ever seen this before, Brian, where we were on a path to something and everybody's kind of reversing it.
Well, the federal government's EV mandate has to go. It needs to be repealed. The government was trying to dictate consumer demand, and they set this target of 100% EV sales by 2035. That was never going to happen, but given the current collapse in demand for EVs, it's even more obvious that that target is completely outlandish. So we need that to go away, and the government should be focusing on those preconditions to EV adoption. Where's the charging infrastructure? We've got a 70,000 charger gap in Canada right now. We need incentives to help consumers make the switch. The electricity grid is not ready for mass adoption. So there's a lot of work to be done to support this transition, but mandating sales, it's not going to work.
So would it be your expectation that additional government investment will be in more traditional types of vehicle manufacturing?
Well, in this current environment, we've got to protect the footprint. We've got to protect the industry, and manufacturers build what consumers want. So right now, you're seeing more demand for hybrids and traditional gas-powered vehicles. They will adopt to that, and they will build to that. And then as you start to see more of those supports for electrification come in, you will see more Canadians switching to EVs. So we've got to be technology agnostic about this. You can't pick the technology, turn it over to manufacturers to innovate and sell products that Canadians want.
Brian, so good to have you with us for this. Appreciate your time.
Thank you.
Brian Kingston, President and CEO of the Canadian Vehicle Manufacturers Association. Time for the takeaway, and 100% of the swings you don't take. When it comes to investing, most individuals are terrible. Left to our own devices, the retail investor is most likely to buy a stock once it's already high and sell it at its low point. We're also more likely than professional managers to trade in and out of the market, something that's calculated to erode returns over the long term. So it was oddly cheering to see this week that Warren Buffett, one of the greatest investors in history, can be guilty of the same kind of mistake. Buffett's investment firm, Berkshire Hathaway, made a stir when it disclosed that it had bought shares of Alphabet, the company that owns Google. Because of Berkshire's reputation as a savvy investor, that news sent the stock higher. But in the wake of its disclosure, Buffett said they originally looked at Alphabet 8 years ago and didn't invest, missing years of upside in the process. Buffett is retiring at the end of this year, and he said he plans to be less public from here on out, turning the management and investment strategy of the firm over at the age of 95. But the admission was telling. If one of the smartest investors out there can make a mistake on a stock, what hope is there for you and me? Fortunately for the rest of us, the answer is blessedly simple. Don't try to outsmart the smart investors. For one thing, you can invest with them by buying shares of Berkshire Hathaway, for instance, and sharing in management's expertise, or even safer, by buying the broad market and keeping your money invested in everything. Investments that track the index may be boring, but it spares us from picking and choosing stocks and making the wrong decisions along the way. My takeaway? It's helpful now and then to be reminded that when it comes to investing, even the best of the best can get it wrong. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.